American Chemical Corporation Final Case Study by Hebo Jurdi. American Chemical Corporation was consistently profitable during the time period of 1974 to 1978. When comparing ACC to other large chemical companies and their financial performance during that 5-year period, it is evident that the company may not be doing as well as its competitors. For example, ACC's bond rating was lower than their next 5 competitors and could therefore impact them negatively. Their average PE ratio was around 5.04, and when looking at their competition, they were severely lagging behind. However, on the bright side, sales were pretty consistent with others in the industry. ACC definitely was not a leader in the industry, but they were holding their own in the sales and net income portion. Also, in regards to their beta at 1.2, it was pretty average, not much of an outlier. The beta shows that the company was definitely performing better than the market, but when comparing it to a company like Monsanto with a beta of 1.43, ACC could definitely be doing better. American Chemical Corporation was required to divest its Collinsville, Alabama plant when it was acquiring Universal Paper Company. The Collinsville plant focused on the development of sodium chlorate, and it was a major player in that industry. Competition was fierce in the southeastern United States, but it was needed in order for antitrust laws to not be violated. In terms of the Collinsville plant's competitive nature, it is important to note that the plant had the capacity to produce 40,000 tons of sodium chloride per year. This is significant because Universal Paper Company claimed the plant as direct competition, and UPC was only able to produce 20,000 tons of sodium chlorate at its Rome, Georgia plant. The Collinsville plant was the largest producer of sodium chlorate in the southeastern United States. However, Universal Paper's Rome, Georgia plant was the second largest in that very vital region. This makes it understandable why Universal would sue American Chemical for a potential breach in antitrust laws. If ACC had successfully acquired Universal and still kept the Collinsville plant under their management, then ACC would have pretty much had total control of the sodium chlorate industry in the southeastern United States. It is important to note that the Collinsville plant was a leader in its region, but it was also one of the largest producers in the nation. The Collinsville plant was doing exceptionally well, and through R&D, ACC was planning on making the plant even more profitable. In calculating the unleveraged beta, it is necessary to find the beta of the sodium chlorate industry, or at least those companies in which are similar in size and sales to the Collinsville plant. Using Exhibit 5 from the case study, the calculation leading to finding the unleveraged beta for the Collinsville plant begins with finding the debt and equity averages from 1977 to 1978 from Brunswick Chemical and Southern Chemicals. These are two companies who would be the most comparable to the Collinsville plant in the sodium chloride industry. They are also relatively comparable to each other, so it is okay to find an average unlevered beta between them. The unleveraged beta comes out to be 0.91. Now, to find the leveraged beta, the unleveraged beta will be plugged into a formula, which the end result finds that the unleveraged beta at 0.91 and Dixon's target DE ratio, debt to equity ratio, at 35% is 1.23. The cost of equity is found using the capital asset pricing model, and it is 18.74%. Assuming a 48% tax rate found in the Excel spreadsheet, the Collinsville plant project cost of debt is 11.25% before taxes and 5.85% after taxes. The weighted average cost of capital comes out to be 14.23%. Exhibit 8 in the case study has footnotes mentioning that the pro forma financial statements for the Collinsville plant are those that Dixon Corporation has calculated through the continued use of unlaminated graphite electrodes. Finding the acquisition's NPV before and after laminate technology is incredibly important for Dixon to gauge whether the investment is well worth what the proposed terms of sale would be. The NPV ends up to be negative 89.3 per $1,000. A negative net present value could mean that the project will not be profitable, but this is if Dixon purchases the Collinsville plant and does not invest in the $2.25 million for the laminate technology. The differences found between projecting the incremental cash flows of the project with investment into the laminate technology and without investment into the laminate technology make the NPV result much more appealing. Capital expenditures in the first year of acquisition will be $2.25 million because of the price paid out for the plant. Every sequential year after that, it remains consistent. In the end, NPV equals $2,931 per $1,000. Seeing this result, it would be best for Dixon Corporation to purchase the Collinsville plant, but only if they are willing to invest into the laminate technology. The proposed purchase price of $12 million for this acquisition seems reasonable enough for the Dixon Corporation, especially if they invest into the laminate technology. The return on investment that the company will be receiving from the benefits will far outweigh any potential concerns they may have had. The Collinsville proposal is attractive on economic grounds because it will enable Dixon to diversify itself. Diversified acquisitions, when used wisely, almost always have a positive impact on the parent company. While Dixon will be financing this purchase entirely with debt, the ROI that the purchase brings within the next 10 years post-purchase make up entirely for that. It is extremely important to note that this acquisition is only worthy if Dixon Corporation invests in laminate technology. This will drive down costs at the Collinsville plant while simultaneously improving revenues through sales increases. The technology will enable greater efficiency, which is well worth the initial $2.25 million investment in 1980. Dixon wanted to acquire American Chemical Corporation's Collinsville plant because it wanted to break its way into the sodium chlorate market. Dixon saw how well the plant was doing in the region and how much further it could go in terms of its capabilities. As mentioned before, the Collinsville plant was the largest producer of sodium chlorate in the entire southeastern United States region, and this is before any type of laminate technologies could be implemented. The acquisition would give Dixon the advantage of having that market share and starting to reap from the profits that the industry has to offer. The paper and pulp industry relies heavily on sodium chlorate producers, so Dixon can also gain ground in that arena by having those people as its consumers. This acquisition seems like a fairly clever decision on the part of Dixon's management. After thoroughly reviewing the financial statements of the Collinsville plant while it was still under American Chemical ownership and going through the pro forma statements drawn up by Dixon Corporation, I fully recommend that Dixon purchase the plant. Management at Dixon understand the risk of pushing the company's debt-capital ratio to 47%, which flies past their targeted debt-to-equity ratio at 35%, but it is well known in finance that with high risk comes high returns. This could also mean huge losses, but so far, based on predictions with NPV and future cash flows, it looks as if high risk will reap some great returns. Management at Dixon may also be concerned with the $2.25 million capital expenditures price tag attached to the implementation of laminate technology, but they should also understand that buying the plant without planning to invest in that technology will call for a huge cost of capital and negative returns. So in addition to purchasing the Collinsville plant, I think it is also extremely vital and financially smart for Dixon to invest in the technology, even if American Chemical will still be managing it with technical support. Dixon is entirely using debt financing to acquire Collinsville, and even though it is incurring risk, that risk becomes minimal in the grand scheme of things. In the short term, the investment may not seem as profitable, but by the 10th year post-acquisition, the plant's returns will be incredibly profitable and well worth the debt it was financed with. Thank you for watching.